I'm going to be optimistic, and I'm going to say that the economy is getting better, the consumer's continuing to spend, and interest rates are going to be going up sometime before the end of the year. I know that puts me in an optimistic, contrarian standpoint, but I think that's important.
Wow. Okay. Well, it's good to know. I mean,
I'm going on the record here. How about that?
All right. So you see one hike before the year's out. You think when's it going to be? December?
I think maybe a little earlier than that. I think possibly a couple months beforehand. But remember that what we've seen in this country is we're seeing stronger consumers. We're seeing housing starts that are increasing. We're seeing a relatively healthy economy here in the United States contrasted with the rest of the world. So as long as we have those spenders, we have unemployment that is decreasing, and we have some optimism here. And we also got still good earnings trends, at least in a lot of our stocks, and we're more in the mid and small cap world, and those have underperformed for the last couple of years. So we see opportunities out there.
Okay, it's good to know because, I mean, the rest of the market basically is in an earnings recession, so you're probably picking some winners there. I hear what you're saying. But George, here's the thing, right? You know, you've got the non-farm payrolls, the jobs report coming out Friday, so we'll get an indication, a new indication of what kind of shape the job market is in. But I hear what you're saying, but the bond market, when you take a look at that, it's not just the curve flattening, it's drifting ever lower, and we're, okay, just off record lows. It doesn't seem to be agreeing with you. Or are you like Mohammed El-Arian overnight,
right?
Thinking that, look, this is really kind of out of our control. It's got more to do with safety money running away from the problems in the EU and also in Japan.
I wouldn't say it's out of our control. Remember that money is going to seek its highest level. So right now the S&P 500 has a yield of about 2.1%. So remember that if investors, institutional investors like ourselves, are looking to make investments, they're not going to be very attracted by fixed income, which by definition is going to pay the same return year in, year out until that money comes back. Instead, why not be a little more ambitious, if you can, with your money? Capital seeks the highest level, so get a higher return in terms of current dividend yield, which is going to increase year over year as long as earnings are strong. So again, we're long-term investors. We have the liberty of buying smaller and mid-cap stocks. Those are things that we think are going to do better for those consumers and those investors that have that liberty of a longer-term investment horizon.
All right, and these names, and probably compliance-wise, you're not able to talk specifically about which ones, but I would assume that they would have strong balance sheets and not be very leveraged at all. Well, okay, go ahead then.
You're exactly right. Yeah, we've got a couple of good stocks. One is Financial Engines, and again, this is a play on the 401k investments of America today. Department of Labor requires that employers do not tell their employees or even suggest their employees what sort of investments to make. So you need a middleman because a lot of the current employees don't really have a sense of how to invest in the market. So Financial Engines, which was, interestingly enough, co-founded by Bill Sharp, Nobel laureate, they help investors, and these are participants in Boeing, IBM, a lot of the big companies that you know in America that are also international companies. They have 401k plans. They have to invest the money. They've got over $100 billion that they manage, and they take about 50 basis points per investor. This is sanctioned, this is legitimized by the employer themselves. So it's a play on the continuing investments of 401k plans. We know that's one of the sweet spots that investors have to increase their net worth over time.